Hello, everyone, and welcome. I'm excited to reintroduce Tyler Otto for today's session, Reservations to Revelations, Unlock Metrics That Matter. Tyler is a president and owner of Specialized Accounting, where he works exclusively with hospitality businesses to help them bring clarity and structure to their financials. So, with a background in hospitality, finance, and years of experience working alongside parks and lodging operators, Tyler has a unique ability to connect what's happening in your reservation system to what's happening in your financial reports. And so today he's going to help us move beyond just looking at your numbers and instead understanding what those numbers are actually telling us. So which metrics truly matter in performance, which ones help create some noise, and how to tie reservations, revenue, expenses, all of it together in a way that helps support smarter pricing and planning for your future. So Tyler has a great way of breaking down complex financial reports into practical real world insights that you can apply immediately. So without further ado, and for our last series in the webinar, Tyler, I'll hand it off to you.
Wow. Thank you, Courtney. Well, I'm excited to be back because I love any chance to nerd out about financials. Now, those of you that might have missed the last couple of sessions, session one, we talked about accrual accounting, accrual intentions, if you will, and why that matters. Last time we talked about some of the basic tax strategies for small hotel, campground, RV resort owners. And today we're going to be talking about metrics. Now, why are we even talking about this? Basically, it's why accrual-based accounting matters, because everything we are going over today, everything I'm going to walk you through and show off that you can analyze and track in your business only happens when you're doing the books by accrual accounting standards. So matching the revenue to the period it's earned and the expenses in the period they are incurred. Well, the reason I love Staylist so much and just keep recommending it to all my clients, I think Courtney and Nick, I sent you one of our clients yesterday saying, please move to Staylist. The reason we love it so much is because it makes the recognition of that revenue on accrual basis as easy as all get out. Dare I say it's automated? Because it is. So I want to show off today what we can do. Now, just to get through the slides, because apparently I have info about me at the front. But yes, I am the owner and president of Specialized Accounting. We're a 15-man accounting firm specializing in the hospitality industry. This is all we do. My background was with five-star luxury hotels, Montage Hotels, Vail Ski Resorts, running their finance department, until starting a firm just for this industry. Also have a podcast that none of you should listen to because it's for accountants. But if you want dad jokes mixed with accounting knowledge and to get an hour of continuing education to get your CPA, go for it. But I don't think that's for all of you. But I love talking about hotel finances, metrics, and referencing 80s musics. Also, I love lists, as evident from above. But today, I want to walk through the financial reports for what Clyde was saying is their newest client on Staylist, the Sesame Street Inn. Cool grabbed, Clyde. Way to go. Way to sign these guys. And we're going to be looking over their financials. And my plea for everyone here is two things. If you have questions along the way, throw them in the chat. I'm going to kick it over to Courtney regularly to say, hey, any questions on this? You won't throw off my groove, the Emperor's groove, if you will, while we're going through this. Yes, you all have David Spade in your head saying that line now. You're welcome. But also, I'm willing to take this conversation wherever we need to. We are going to start super basic. So for those of you that see like the first few metrics we look at, and you're going to be like, well, I don't need this webinar, like this is super basic. No, stay around because we need to build on it. We're building a foundation and we're going to go deeper and deeper into the financials to really analyze how we can improve operations at a business. And then we'll talk about, again, at the end, why Staylist helps with this. So that being said, I want to just talk you through an easy scenario. Now, in the hospitality world, whether it's campgrounds, RV resorts, hotels, we refer to heads in beds or people in campsites as room revenue. So you're just going to see it in here, but this can apply across all product types. So oftentimes business owners will just say, hey, cool. I'm looking at my room revenue by month. Maybe, it's a smaller business and you take $500,000. We're only doing $50,000 a month. Maybe it's a bigger hotel and we're doing $1.5 million. I just went with, a decent sized hotel. And let's say they're doing 500,000 a month in revenue, July sales tank, and then October it goes up. And you're like, oh, cool. July's not a very good month for us. And October is one of our greater months. Well, then we want to start looking at profit by month because this is how much after all your expenses you bring into the business. And it's the simplest metric. Again, I warned you guys, we're starting simple, but the number one thing you can do as a business owner is track the revenue in the period it's earned against the expenses that are incurred that period. I'm talking labor, you're spreading out insurance by month, you're accruing utilities into the right month, software subscriptions, everything, so that you can come to find out that, ooh, we actually have really good profit in May. And then, the rest of the year it comes down, but all are great months. What really tells the story for us, though, is looking at this as a percentage. We're looking at this as profit margin, AKA for every dollar that comes in, how many pennies make it down to the bottom line as profit. And this is the first thing we can start looking at when we have revenue recognition right. Because I'm going to switch up that orange line to say my profit margin, and we have it represented over here by percentage. And we can actually see, regardless of what's going on in sales, we have awful profit margin going into August, September, October. And many business owners miss this because if they were going to look at this solid orange line of profit and be like, woohoo, look, we made 28% profit this month. We're doing awesome. Compared to that revenue, this is actually one of your least performing months. You have a severe operational inefficiency in your business because you went from having 30 cents of every dollar make it to the bottom line down to 21 cents. What happened to lose 9% of all your revenue? Maybe you had some sort of inefficiency, or maybe something else we're going to look at here in a second. And that's why we love these margins, because we call profit margin one of our smoke indicator metrics, where it doesn't really tell us what's going on in the business. It just tells us that where there's smoke, there's probably a fire. And so we need to look into what's going on in these months where revenue is just through the roof, but our profit margin is not solid. And so, as we look at this in our financials, how did that jump in there? Sorry, everyone. My slides moved on me. Clyde, entertain them with the dance real quick. Okay.
Hit us with some moves there, Clyde. How's that?
All right. We're going to roll with this out of order, but I think I can adapt. So, everyone, thank you for humoring me. So, then one of the next metrics we like to look at if we know that we have operational inefficiencies is we look at something called cost per occupied room, where how much does it take you if you're a hotel to put a head in a bed or put an RV on a slab? We're going to look at, and you would just say cost per occupied site, but we're going to start looking at what is that cost for every single night we have our bed or site occupied. And so a lot of businesses, that same one in particular, they'll look at it and be like, oh, well, our total expenses in our rooms department, it's relatively consistent, but it goes up in July, August, December. But that doesn't tell us the whole story. That, if we put it next to the number of occupied room nights or occupied site nights, all of a sudden we can do, well, what's our average cost per site, per room? And that will tell us a very different story. And this is one of those metrics that absolutely every business owner should be looking at, because for us, we've got that same expense here where you could say, oh, this 30 grand was bad or this 27 was bad. No, we're staying around 60, a couple efficient months, 72, 87. What happened in November? Where, again, if I go back to our numbers, we only had 131 occupied room nights or site nights, but we were spending $172 per night. Now we know what months we need to look at. Do we have a staffing issue? Do we have a cost of goods sold issue? Do we have a utilities issue? Now we can start seeing that, hey, the P&L doesn't tell us everything. These metrics are going to help us identify those issues. And that's why we love this metric. For our clients, we're often looking at cost per occupied room, and we're always comparing it to the prior year. So does this make sense? Right here, we have current year in green, we have prior year in gray. Well, it looks like every year in November and December, this goes up. So maybe it's normal. We want to be able to explain it, but it's going up much higher this year. And again, You can't do this without accrual. And especially as we start getting into these next few metrics about revenue, this is where you need stay list posting the revenue, regardless of if someone paid you in December for a reservation in May, you need to be recognizing that revenue in May. So this is one of my favorite metrics. And as I jump to it, I'm going to stop right after I reveal this to you, and Courtney, see if we have any questions so far. But when we get in and usually look at profit margin and why it's doing poorly, or we look at cost per occupied room or cost per occupied site and say, why is this going poorly? There's almost always two of the biggest culprits. It's usually either a labor margin issue or a cost of goods sold margin issue. It's either you have something going wrong with housekeepers and staff turning sites, or maybe you have guest amenities. You have you have the shampoo bottles are getting stolen by someone, or you have linens, towels that are getting stolen, or you have just some sort of inefficiency that, things are getting spoiled. Even if you guys have a restaurant component, this is usually one of the biggest indicators for an F&B component, is that you have a cost of goods sold issue, and we'll get into what those are. Before I dive in to these two margins and how we track them and how we triage them, Courtney, do we have any questions so far?
Not in the chat. Not yet.
Awesome. Okay. I either scared everyone off or I'm crushing it. I'm going to
We do
choose
have
the
a hand
latter.
raised.
What was that?
We do have a hand raised. Sean?
Chat's not work. Chat says it's disabled, Courtney. So I don't know if anybody else can get into it.
Did you click on the bottom where it says Q&A? You should be able to type a question in there.
I did not, but I know the chat feature is disabled. So
I'll figure that out.
all right.
Cool. Well, if anyone has Q&A, hopefully y'all can post your questions there if you have them along the way. So let's keep this party rolling then, because let's talk about these two metrics, labor margin and cost of goods sold margin. And I assure you, for almost all of you out there, taxes and labor will probably be your two biggest expenses running a hospitality operation. It's just truth in the matter. So let's start with labor then, because that's where we live. So if you're tracking your labor accurately and recording those expenses in the period that your guests are staying with you, again, a lot of business owners will look at it and be like, oh, my labor is really high in June and July. Like, we need to figure out how to get that down. And look, we saved money in October. We're doing good. But that means nothing to us until we put it next to the revenue for that department. Same numbers here in blue for labor, but now we can see what this hotel in this scenario was doing. Turns out they're a highly seasonal business with July, August, September, huge revenue generating months for them. And then going into the winter seasons, they struggle. Well, now I'm honestly a little bit scared of some of these months because, I was really excited about a $52,000 in labor in April till I put that next to revenue. So let's do a labor margin metric. Oh, see, I'm going backwards, guys. I'm sorry. Let's do a labor margin metric where it's just the cost of labor per dollar coming in. And now we can see that we have two absurd months. Something's going on here. November, your labor per occupied room is insane, as well as in April. Now, for some businesses, this could be normal. Maybe you always leave someone staffing the front desk and no matter what, you can't get that labor down. Or a lot of times we'll see places, particularly hotels, that they don't flux their staffing. They don't say like, well, we only have so many rooms, so we'll just keep the housekeeper coming in or the maintenance staff coming in on their regular schedule when we have very few people coming through the property. So we need to be able to look at this and say, what can we do to get costs down in labor during these months where the average spend is 50% more than what we brought in for revenue? And this is one of the things, staffing models, this is where they play a huge deal with figuring out how you can adjust labor. Meanwhile, I almost get a little bit scared for some clients when I see like their labor is so low. Like, are you delivering a poor customer experience during these high peak times for the sake of keeping labor low? This almost should be a scenario where you're looking at like, do you need to flex labor in the other direction to improve the guest experience when you have a high throughput during this time? I'd be looking at customer sentiment and seeing if there's any complaints of like things are broken and not getting fixed, the bathrooms are in ill repair, any sort of feedback here. So this is a really great way to get an idea of how your staffing models are affecting your business. And again, I'm just going to go back to it. You only get this visibility if the revenue is recognized correctly. So we'll jump into that a little bit further. And then when it comes to triaging what went wrong with your labor, there's usually three options, almost always. One, it could be overtime. Maybe you're super busy, and if you have insane high labor margins, it could just be overtime. And honestly, I don't hate this. If you have high labor margins for 2 months because you had to go into overtime and pay staff, it probably makes sense to pay those employees time and a half than try and find brand new employees to cover those 2 months of the year that you're insanely busy, right? I think of, a couple clients where it's just 3 months of the year, they have, a restaurant on the water and they just print money for 3 months, but they usually can't find staff to only want to work 3 months and be up to par. Sometimes people work overtime. This is where you analyze and see what works for your business. Sometimes it's an issue of they're overstaffed. When I see labor margins really high, are they keeping too many people on the schedule? Maybe they're keeping 2 people at the front desk year round when they don't need to. Maybe one person and then a call box off hours would save time and money. This is an absolute easy one to fix as well. But the one I always get scared of is the accountant. And I say this because we find this at least once or twice a year, is wage theft. Kid you not, we had one property we were working with in Salida, Colorado, and slowly month over month, labor margins started going up for the room department. And we're trying to figure out like, hey, what's going on? Is there anything different? Do you change cleaning procedures or staff having to do more? Couldn't figure it out. So the accountants over here were like, well, this just doesn't make sense because your average hourly wage is the same, but employees are taking a lot longer. Then they start looking at the time cards. They realize that a lot of it is attributed to one employee. And then they go look at the security cameras and find that that employee was sitting in this little alley cove between two of the rooms that went to the back of the hotel and was sitting on her phone playing for an hour every day. I assume Candy Crush because that's my go-to joke, but insert your own favorite app there. But they were able to find that because the nerds over here, the bean counters, were like, hey, this doesn't make sense. Something's wrong with the labor margin, and you can go investigate and find out. So if you have labor margin issues, this is exactly where I would be looking if I had a campground, hotel, RV resort today. Any questions so far, Courtney?
Doesn't look like it, not yet.
Sweet. All right, keeping this party rolling then. Then there's one other thing I told you is usually a problem for most business owners, and it's the cost of goods sold. Now, we could talk about this on a rooms department side, but this is also true if you have maybe a retail store on site or a food and beverage component or a restaurant. I really like the restaurant side because it's really easy for me to talk about. So that's going to be the demo I show here. But this is true for all lines of business as long as you're tracking it correctly. So for us, again, we'll look at cost of goods sold. For those of you that don't know, cost of goods sold are just expenses that you only incur for each proportional amount of income. So restaurants are super easy because it's the food, right? You're only selling that hamburger once, I hope. If you're not, we have a whole separate issue we need to talk about. But that's going to be that incremental expense that goes up for every dollar earned. And a lot of business owners, man, the amount of times I've seen it, where they're just like, look at October, man, our food costs are through the roof. We need to do something about it. I even had a client try out an AI platform to help analyze their business. And it flagged that October was a severe concern because cost of goods sold were way out of line. Like AI would flag this and say you have an issue. But if we put revenue next to that, now all of a sudden we say, well, cost of goods sold is going up, revenue's going up. Okay, Tyler, you're talking margins. I think this is okay because both are increasing. But this isn't enough for me. I want to see that little margin. I want to see what is the dollar spent in cost of goods sold for dollar of revenue brought in. And now if we look at that same expense line, but with a nice little graph on how much we're spending in food COGS, oh man, this tells a different story. Yeah, we actually should be concerned in October because we're sending 41 cents on every dollar to turn out a hamburger or a salad. Why is that so different from middle of the year? We were doing 33, 34, 35, 32%. I like seeing my clients super consistent. And so this is the fun part because if you have a retail component, I mean, you can absolutely track this as well within Stay List because it's going to sync over those revenue items for your retail shop and let you see this. Obviously, if you're running a full scale restaurant, maybe you have a different system. But man, it just makes it so much easier to get this sort of visibility. And for a lot of our clients, if you're talking about a 10% shift, let's say, from your most expensive COGS month down to your cheapest, on 130 grand, that's $13,000 you're missing out on just by not knowing where this money's going. So, another metric that we highly recommend all of our clients should be looking at, and again, we can put it side by side, but there's your revenue and expense. But if we look at that expense as a cost of sale, we can see that while April and May look like nice low months, they weren't. They were insanely high months, severely problematic, and it helps us look at what months to investigate. So I love cost of goods sold margin. And just like with labor margin, two things we wanted to talk through or three things that usually cause the issues here. First off, it's waste, whether this is in your rooms department, putting heads in beds, maybe it's staff are not being very frugal, or maybe you need to go to like one of those soap dispensers on the wall rather than individual containers because you just have so much waste with stuff getting thrown out in a restaurant. This is usually extremely relevant because maybe people over order for a complimentary breakfast option and then they have so much stuff getting thrown out or they're putting out too many options. And so we want to look at how much we're throwing out every day. I actually have clients that have a special trash can that at the end of every service, they weigh that trash can and they know how much poundage of food they're throwing out and they can try to start reducing that and eliminating it. Great ways to go. Some other ones, it's spoilage. We've seen this with clients as well, where they over order and they just have stuff go bad. This is a really big issue, especially for seasonal clients that don't like think about, oh, we're going to close down at the end of October, early November. Maybe we shouldn't order our usual order of perishable goods on October 20th. Maybe we should wind that down. And so spoilage is one we see a lot, particularly for seasonal businesses that shut down. They take a huge hit in November, December, having to throw out all that stuff. But the biggest issue I always want to watch for as well, and again, we see it once or twice a year, is theft. Working with a hotel in New Mexico, and they tracked their cost of solds for food by grains, by proteins, by produce, and we tracked it all. And proteins, that cost of goods sold started going through the roof. And for several months, we couldn't figure out why, but the accountants were saying, hey, something's not right here. You guys clearly have an issue. Turns out they go check the security footage. They find two employees that are taking racks and racks of ribs out the back door and selling it to friends and family. You find that when the accountants are asking questions because you have this sort of visibility. And so, again, I can't recommend it enough. Labor margins, cost of goods sold margins, this is what you need to be tracking at all times. Any questions here? Have a feeling the answer is no, but I'm just keeping it open.
None right now.
Yeah. Either way, it gives me a chance to take a breath. Okay, so let's talk through a few other things because many of you, I'm sure you get started as a mom and pop business. The discount margin is usually one that always afflicts the mom and pop. We'll have businesses all the time that, a husband and wife, they start the business and then maybe Uncle Jerry comes to work with them. And Uncle Jerry gets really comfortable behind the cash register and starts looking at just, I can comp my friend this and I can hook my friends up with meals or, discounted nights or really just taking advantage of the situation. We like to look at revenue per customer because we can say, oh, cool. How much revenue is coming in? This orange line is associated with these dollars per customer over here. And we can start seeing that, hey, even though revenue was going up, revenue per customer took a dive in October and it was really low in July. Well, why did that happen? We want to look at what percentage dollar amount we are giving away per dollar in revenue. And if we put that on there, those things side by side, we can see that our discount margin every month went from 10% to 12 to 15 to 22 friggin' percent. And you guys think I'm making this up, but this is an exact example from one of our clients where family member comes in and just slowly starts hooking up friends and family with discounts. Now, if you guys are just saying, hey, whatever money hits my bank account is the revenue, you'll never see this. If you're using a property management system like Staylist, you can have those discounts mapped so that you're seeing the gross revenue and the discounts broken out. And now you can start tracking a margin like this and seeing if someone is giving away a lot of your income. Because usually this just goes unnoticed for months, dare I say sometimes years. And it happens all the time. Family-owned businesses, we see it all over the place. So one of our favorite metrics to track as well, discount margin. And with that, if I go one more, we call it comps and discounts in this industry. This is another real example from a client, so pardon the graininess, but we pulled straight from their financials, what was going on in revenue in green and discounts. And we're putting those side by side. We knew that we never wanted to see more than a 10% discount margin. And then sure enough, something's going on in August and September. Yeah, you better bet immediately we want to start looking into that and seeing, hey, where's this money going? Are employees doing any shady things? I mean, the discount margin, it's shocking, and it sometimes ruins family relationships, but it's a great one for y'all to be tracking. So those are the initial metrics I love to cover that accrual-based accounting would help you guys out with. I honestly would love to go even further and start talking about some cash-based metrics, but I will happily pause here with a Princess Bride picture because that is arguably one of the most quotable movies of all time. Stop again for questions while I get a drink. Courtney, anything?
As you wish. There are no questions right now, but it is one of the most quotable movies, so I had to do it.
Literally, like half the time we end team meetings with "have fun storming the castle." Yeah, and my wife will frequently tell me, "I'm not a witch, I'm your wife." So, anyways, sorry. If you guys have a favorite quote, throw it out there in the chat. Even the ones we can't quote. All right, well then I'm going to hit a few other cash metrics that I love to look at because though I skipped over it, we often say in our firm, revenue is a vanity metric, right? Like you'll get talking to those people like, well, I have a 3 million a year hotel. Well, I have a 20 million a year hotel. And I've seen people get on stages at some of these conferences talking about how they built their 20 million a year hotel. Well, I do their finances and like, you haven't posted a profit in 6 years, dude. Like revenue means nothing if you're not posting profit. And so profit is actually a sanity, but that profit means nothing if you're not cash positive and can pay your bills. And it's amazing, but all these three things are not tied together. You can have revenue and no profit. You can have profit, but no cash. And so we like to look at cash metrics to help make sure that we are staying in a spot where we can cover bills and unforeseen issues as they pop up. And so let's talk about one of our favorite runs, but this is burn rate. Burn rate basically just looks at how much do we spend in an average month. So in green here, I've got how much we're spending in operating expenses every month at this hotel. 148, 114, 90, whatever. As an average, we can see it's this line right here, around 120K. Now, if we put that next to how much we have in our bank account at the end of every month, we can see that, at the end of December, we had 380K in the bank. At the end of July, we had 455 in the bank. Cool. Well, burn rate or runway is how much we have in the bank divided by the average monthly expenses. And this tells us our runway for cash. Our burn rate is how much we're spending, and our runway is how many months we have that we could operate without collecting another dollar. Healthy businesses always want to have at least a runway of 1 month. I like to see my customers or clients we're working with at 3 to 6 months of a runway if they can. And I know that sounds absurd, but it allows businesses that are in this unique spot to have the cash reserves to jump on opportunities should they pop up, to weather storms. We all laugh, but 5 years or 6 years ago, it would have been absurd to say, well, what if the government, my local government shuts me down from having guests because of a worldwide outbreak? be like, well, that's the dumbest thing I've ever heard. It's never going to happen. Until this was a real problem for clients of ours years ago. We had another client who, as we get, actually, I'll save that story till we get into working capital, because this one's really going to tell a great story. So I apologize. I'm going to get a little ahead of myself. We also have another metric called working capital. And this basically just looks at your current assets. Now, those of you that hated accounting 101, your assets are just what you own. So it's your bank accounts, it's your receivables, it's basically your money that's yours, not including fixed assets, right? Your property and land. It's just how much you have in the bank and how much you have coming in from guests. That's current assets. And we like to put that next to our current liabilities. And our working capital basically says, okay, if we take everything we have in the bank and what we have coming our way and we subtract what we owe, maybe what we owe in credit cards and what we owe in advance deposits because we're sitting on customers' money, we can see if we're sitting positive in our bank accounts or negative, and that's working capital. And so if I go back in one slide and look at this client right here, they were sitting on, 400 grand in the bank in June, 500 grand in the bank in July. But if you notice, their liabilities exceeded that. This client in particular, if you do accrual-based accounting, you don't recognize the revenue that you collected from customers for advanced deposits until they stay with you. That revenue sits as a liability saying, hey, I'm sitting on other people's money that I haven't earned yet. And that's what's happening here is we're saying, hey, we've got 400 grand in the bank, but we've collected over 600 grand from people for future reservations that we haven't delivered services on yet. So if we look at this as a metric, this client at one point was negative $240,000 in working capital. That means they were sitting on, or they had spent 240 grand more of what their prepaid reservations were than they had left in the bank. Now, a lot of you are like, cool, Tyler, not a big deal. Because at my operation, we have a no refund policy, right? Like we are never going to have to pay them back that money. So if they cancel, that's still our money, not a big deal. I argue otherwise. Because we had one client who, if we look at this negative 240,000, they were outside Yellowstone National Park on the north side of Montana. And what was it, like 3 years ago, there was a giant rainstorm that washed out the road into Yellowstone National Park. You could no longer get to our client's property. Do you think their no refund policy stood up when people contested it saying, hey, I can't even get to the property? Like, I'm not canceling. I literally can't drive to your property. You guys got to refund me. Well, all of a sudden, all this money came due and they did not have enough in the bank. Now, luckily, these clients were Mr. Moneybags and just pulled from some other business and were able to cover it. But not everyone has that luxury. And so this is one of those cash metrics that you always want to make sure you have more in the bank than you could potentially be liable to any of your customers. We call this something a little more simplified, which is just your cash, because when we were talking on the prior slide, we were talking about current assets, which includes maybe you have invoices out there that you're going to collect on, but it's not in your bank yet. We like to make it even simpler and just say, what's in your bank account for minus advanced deposits? We ignore everything else. And still, this client went super negative for a couple months. This is where I get super nervous for my clients, because if their property burns down tomorrow, they don't get to keep this 215K. You would better bet all those customers are going to be demanding a refund and contesting their charges. So cash metrics, this is a huge one to monitor to stay just out of a precarious position.
We do have a
I can
hand.
hit on a couple. Sorry, go ahead.
We do have a hand raised.
Okay, what do you got?
Mary, can you talk?
Maybe.
I think you're muted, Mary.
Not.
I think we
We
can
don't
hear.
hear from her. You're always welcome to interrupt me and we can go to the chat.
Okay, we'll do that.
Okay, cool. Well, then I might hit a few more and then let you guys out of my favorite little land of graphs. And we can show in stay list how you can set up this integration. Or Clyde, if you got a different direction you want to go, we can absolutely do that. Perfect. So there's a few other ones that you guys should be monitoring, and this is what I love to see. Because in stay list, it becomes easy. You guys should, as operators, already be looking at your occupancy and your average daily rate and pacing. I'm not going to spend a lot of time on these, but I'd be remiss if I didn't say business owners, you should be looking at these on your financials, such as your occupancy. You just say, hey, what is your total rooms available divided by your rooms sold? And we always want to see clients trying to maximize this. This is one where it's amazing how many operators I've talked to that when we're prospecting them, they're like, well, we don't really know what our average occupancy is. And this is your number one lever, is playing with price, your average daily rate, to increase occupancy. So we love seeing this from our customers, as well as average daily rate, and looking at these two in tandem. We love looking at them over year, so that we can see that, oh, this client, they really dropped the average rate this year compared to last year. If they were selling rooms at 1/3 the cost this year, I really hope they tripled the amount of occupied rooms. Otherwise, this was a bad decision to drop it this low and run some sort of promo. So make sure you're looking at your average daily rate. Really, though, with all these metrics, I just want to hit you with a couple best practices, and then Clyde, I can kick it over to you.
One of the
Cool.
questions,
Yeah.
Tyler, was, so you're saying that clients should be using accrual accounting in this industry?
100%. So, if you guys were here for the first webinar, we talked about the importance of accrual-based accounting. And many of you might go to your account tomorrow and say, hey, I heard this guy on an internet with a shiny forehead say that we should be doing accrual-based books. Now, your accountant's probably going to be like, no, we do your taxes on cash basis. You can file taxes on cash or accrual. It doesn't matter. If you're sitting on a lot of advanced deposits, usually accrual is better. If you're not, cash is usually better. Regardless, though, you should be managing your books on accrual basis so that you can see these sort of metrics. If you don't do that, then you won't be able to see any of the metrics I've shown you today. Basically, if you took all your advanced deposits for the season in December, you will have zero flat line of metrics for all of this year. So another question I saw there, do you have the previous webinar we can still access? Yeah, Courtney, I think you guys will be publishing those as well. Where should they find those online if they want to go hunt them out?
I'm going to actually drop the YouTube link in here and see if they can access it. I'll do it in the Q&A and in the chat. But it's on Stay List YouTube channel.
A few other best practices real quick that I'm going to hit you guys with. But these metrics that I showed you today, the KPIs are only as good as the financials. So if you guys are just throwing everything in the bank account and no one's actively managing them to do the books properly, you're not going to be able to get quality metrics. In fact, you might start chasing a squirrel up a tree here and going in the wrong direction because you might think there's an issue, but the underlying data that helped you get these metrics are completely flawed. So make sure that someone is regularly doing the books and that they know what they're doing. The beauty is that if you're ever concerned on the revenue side, if you're doing it right, you can go into Stay List and see what is my advanced deposit balance and make sure your books match that. You can go in and see what your guest ledger is and make that match up. Like, the reporting is super simple and easy. If you are big enough where you have a specific finance person, granted, I know I'm a numbers guy saying this, but so many operators have finance people that are scared to say, hey, I think we have an issue, because owners will often turn around and say, what is it? And the finance people are scared. They don't know what the answer is. They're just like, hey, this number is incredibly high. And operators and owners will often say, well, it's your job to figure it out. And finance people don't know the day-to-day operations, or the bookkeepers or the accountants. They don't know the day-to-day operations as well as the operating staff. You need to get operations team involved in trying to figure out what's going wrong with efficiencies and metrics. So give grace to your accounting team, your bookkeeping team, your whoever's working on you. If it's your spouse doing the books, encourage them to surface the issues, even if they don't know what's causing it, because you need to first know where there's smoke before you can find where there's fire. And then lastly, What I will say is I've shown you plenty of metrics today, and I've got like 80 more depending on the client that we're looking at. But my recommendation to you is keep it simple to start with. If you start trying to build a dashboard, whether it's you or your accountant, that you're trying to monitor every metric in the business, you're going to get overwhelmed because you're trying to fix 90 things at once when really start simple. Start on profit margin, labor, cost of sold, and discounts. Focus on those to start. And then if you realize if you have a guest supplies issues, then start looking at those margins. Or if you have, an overtime issue, start monitoring that separately. But work your way up to it. Start simple so that it's easy on you to get going and build this out. I'm going to jump real quick to this question. If we're not using Staylist Channel Manager for OTAs and we are listed on many OTAs, how can you get true readings on your KPIs? Okay, yes. And is this possible within QuickBooks? So for anyone that maybe is new to this industry and you're trying to figure out if even you want to go this route, OTAs, online travel agencies, Expedia, Airbnb, Booking, Camp Spot, no, what is it? Camp, oh my gosh.
Hip
My
Camp.
friend that owns, what?
Hip Camp.
Hip Camp, thank you. All those different OTAs, they take a percentage. Yes. So we, at our firm, what we're doing is you're recognizing the revenue in the right period. So someone pays, in December for a reservation today in February, we take the cash, put it in advance deposit, and then we recognize it today. Staylist automates this for you. Then you want to make sure that when you're booking the expenses for Airbnb, Hip Camp, all of them, you want to be recognizing that expense in February. Now we're going to run a margin on how much we're spending in OTA fees per revenue. And we can start tracking, like, are the OTAs killing us, right? A lot of customers, the next easy shift they look for is going from getting all their customers through Expedia at 18% and trying to shift them to direct bookings on the website for 3%. With your credit card fee. That's an amazing shift to monitor. So yes, you can do this in QuickBooks. Very easy. That was a fantastic question, whoever that was. Gold star for you.
And Sean, you're also able to see the ADR and the net ADR and the ADR and RevPAR report in Staylist, so you can get accurate KPIs there as well. So it's not skewed.
Beautiful. Beautiful, beautiful. So all that being said, that's what I have to kick it all off. If anyone ever wants to talk to me about accounting, I will happily nerd out with you. You can reach me at the QR code or at my email. Otherwise, Clyde, Nick, Courtney, any other direction we want to go right now immediately?
I'm going to show a few reports within Staylist that kind of tie into everything that you have discussed over the last 3 webinars. So I'm going to go ahead and share my screen if that's all right with you.
You guys are brave souls for letting me talk on here without looking at everything I'm saying first.
We believe
We've
you're the best
trusted you.
hospitality accountant in the world. Why would we not trust everything?
You're our favorite
Wow.
CPA, Tyler. We trust you with everything.
Well, thank you.
All right. Let's pull that up here. Everybody see my screen?
Yes, ma'am.
All right, perfect. So for those of you who have just joined us for this last webinar, or if you have been with us for the entire time, the past couple of sessions that Tyler's talked about, we've talked about tax strategy, accounting methods, and how your finances are really impacted within your business. And so today we're going to bring in, how to look at it through your day-to-day operations, because all of the strategy is all good, but you're going to need data behind it. So I'm going to start with the daily summary. If you go to your reports and then you go to accounting and then you go to daily summary, we're going to run it for the entire month. I'm in a demo atmosphere, so it's better if we look at a whole slew of data. So this is just going to bring to life what's inside Staylist and really show you what this actually looks like day to day. So here you're looking at the daily summary report, and this is where your operations and your accounting kind of come together, right? So I have this set of a data range, and most operators, they look at it daily, but here we're just going to look at it for the entire month. But again, recommend looking at it daily and not just at your end of the month to kind of keep up with what you have, where you're going, and what you're going to look for, right? So here we're going to start at the top with revenue. So this is going to be your revenue breakdown. So what I love about this is that you're seeing not just a total number, but you're seeing exactly where your revenue is coming from. You've got site types from your backends to your pull-throughs to your cottages. And then you have things like add-ons, like checkouts, golf carts, even cancellation fees. So this is, where you can start asking the question like Tyler was talking about, what's actually driving my revenue, right? Are my add-ons being utilized? Are there certain site types that might be underperforming? So this is what's going to feed directly into your financials so that this breakdown, if this breakdown isn't clean, then your reporting on the back end, it's not going to be clean either. And then he talked a lot about tax strategy. So as we move here, we're just tying into what Tyler's been talking about. And you can see all of your different tax layers, city, county, state. It's all broken out and applied correctly. And this is going to be really important to make sure that you are just ensuring that you're, collecting operationally and actually what matches and what you're responsible for financially. So if this isn't right, then this is where you're going to run into issues like overpaying, underpaying, and spending a lot of time, trying to clean things up. And then here, you have non-tax revenue. I'm not going to deep dive a whole lot into that because I'm not the accountant. If you guys have any questions for that, ask Tyler. But this is, one that you don't want to overlook as well because it's really important. It shows you what revenue is not being taxed versus what is. But then you have your tenders here. It's just going to show, where your money's actually coming in, whether it's cash, credit, maybe you have, you take check or ACH payment. These are all going to be broken down here. And this is something that your team should be looking at to be reconciling at the end of the day. And like I said, something that you really need to be focused on daily and not just at your end of the month. And then at the end here, we have deposits and balance due. These are going to be broken down here as one of the most important sections because it shows you your cash flow, right? Your advanced deposits, what's been used, what's still outstanding, and it tells you what you've earned, but not actually what you've collected, which is what Tyler's been touching on these last 3 sessions. So you might look profitable on paper, right? But we want to make sure that we still have cash flow issues and how to prevent that. So this whole report isn't just a report, it's really answering 3 questions that you might ask yourself every day as an operator. How did we perform? Where is the revenue coming from? And what still needs attention? So before I move on, does anybody have any questions on daily summary? And I'll touch on trial balance real quick. I know we don't have that much time, but I just wanted to hit some really important reports by the end of the session. Good, keep going. All right. So what you're looking at here is going to be your trial balance. So I'm not going to go too deep into accounting here. That's not my forte, that's Tyler's. But I just want to show you exactly what you're looking at from a financial standpoint. So this is going to look really familiar to what your daily summary look like, right? What your site income looks like, what your cottages look like, what your add-ons, what your occupancy fees look like. And this exact revenue is taken from your daily summary. And that direct connection is where your team can look at what's directly operating and how it builds into your finances. So it's just, something that your daily balance is showing up here as well. So the assets are at the top. This is where your cash, credit, receivables, all of those lie. And this is showing where your money actually is. And then, we looked at tenders earlier, and this is where your money lands. So then you have your liabilities, which will be down here. And those include taxes payable, security deposits, and prepayments, all the things that you've collected, but you don't actually own yet. And a lot of operators get tripped up here because they're like, oh, well, we've collected this money, but that doesn't necessarily mean that it's revenue yet. And then just tying trial balance, as a total, your daily summary is actually looking at what's happening operationally. And then your trial balance shows how it's financially structured. So if these two don't align, then you're going to start running into reconciliation issues, confusing reports, and then finally, lack of trust within your numbers.
And then, Courtney, if you want to stay on the trial balance, go back there for a second.
Yep.
I was just going to add, so when you think about your accounting system versus your operational system and your PMS, this is your chart of accounts. So you're not wanting to have a ledger for every single unit category, unit, everything within your system. These are just your GL accounts. So you have your standard site income, your seasonal site income, cottage, your high level categories that you want on your GL account that goes into your accounting system. So the reason for the trial balance report is one, understanding all of how it matches to your financial system and also integrating with your financial system like a QuickBooks or Sage, we have a direct integration with QuickBooks. But if you have other accounting system, not QuickBooks, you can run an export and do that typically on a daily basis. But in your daily summary report, that's breaking every single one of your unit categories out and all of your components and charges out so you can see operationally where exactly that ties. But the reason you would use that over this and this over that is based on if you're looking at your accounting statements and your accounting reporting versus operational detail. But back in the daily summary report that Courtney was showing a minute ago, it shows which GL account that ties to. So if you go in and sum them all up, that shows how everything accrues and just make sure your mapping is tied in there.
Awesome. Thank you, Clyde. And one more thing, just to spin off of trial balance as well. We have our reconciliation dashboard, and keep in mind this is all going to be demo, so you're not going to see exactly numbers like you would see in your system, but you can look at it through transaction date and by payout date. So if you were to pull up your trial balance by transaction date and it says February 23rd, it's going to give you the payout date of, let's just say, February 26th. When you look at February 26th, you click payout date, and then it'll bring you to where that transaction date lied within your trial balance. And this is going to be real time within your Stripe dashboard into Staylist. So it's going to show you real time money, real time payout, and real time clearing. And like I said, it's going to get a facelift soon. So it's going to be one of those things that you guys are going to be using day in and day out just to make sure that all of your financials are checked and balanced. So yes, I see Sean has a question.
Yeah, I have a question, and Tyler, you might be able to help answer this as well too. If you were a cash-based system in Staylist like we were originally, and now you're converting to accrual, what reports need cleaned up from the old cash base that was left in Staylist to make sure that all your accrual is correct now?
Yeah, the biggest ones you're going to want to do is your balance sheet needs to be cleaned up and you're just going to have to do, unfortunately, lump sum true up entries as of what I would do is December 31st of last year. I almost always recommend do the change at a year end. And you're going to true up your guest ledger and your advanced deposits and city ledger if applicable to match up. Those are going to be the biggest things. And then you'll also have, a revenue clearing account where let's say you have, revenue that was recognized on December 31st, but it didn't clear Stripe until January 2nd. Like you're going to have a few of those you need to clear up, but advanced deposits and guest ledger are the biggest things. And then if you're switching how you file taxes, make sure your accountant does Form 3115 change in accounting method.
Awesome. Thank you. All right. And then this will be the last one that I show you too. Tyler talked a little bit about, how making smarter decisions operationally can make really big decisions revenue wise. So one of our, key reports that I always refer to operators to use is our ADR and our RevPAR report. And this report is really focused on performance, right? Not just what you made, but how efficiently that you're making it. And so these are going to be, top metrics that you're going to want to look at. So here you have total rooms sold, you have total rooms collected, and your ADR, which is your average daily rate. And this is simply meaning how much are you making per night per site? And this is one of the fastest ways to understand if your pricing strategy is working or it's not working. So your ADR chart here, this is really powerful, right? So you can see ADR broken down by each site type or unit type, and you can immediately spot things like which units are driving the most revenue, which ones might be underpriced, or where do I have opportunity to optimize revenue, right? So here, when you look at revenue totals, this is like the same data, but helping you understand why these numbers do what they're doing and why do your revenue numbers look the way that they are, and then why do your financial numbers look the way that they do. So if you really want to understand what's driving revenue, then this is just one level deeper. So your ADR, if you look at the table here, is really going to be broken out by detail, by room type, by site type. And this is where you can start making these intentional decisions on making more money. So let's take something like our standard pull through here. We have strong volume, we have strong average rate, and we have a solid amount of revenue coming in. So we know that this specific site type or unit type is a strong performer. But then you compare it to something like the standard back end, right? So you might be selling more of them, right? 207, but at a much lower rate. So you're filling them, but you're not making nearly as much per stay. And this is exactly where you can identify where you're leaving money on the table. So you can see here that, you have your highest rate units, but you have lower down in volume, and you can find opportunities to drive demand. One of my favorite things to talk about is, okay, well, if we're sitting at 80 to 100% occupancy, we might be a little too cheap, right? So we might want to raise those numbers up a little bit. And then you have missed opportunities here with no usage. So maybe they're not being marketed correctly, maybe they're not set up correctly, or just not being utilized. And so this is where you can start making operational decisions like, do I adjust pricing? Do I shift demand? Am I maximizing every revenue opportunity? And then one question that Sean actually had, if you do have that channel manager OTA connections, your net ADR is actually taken in your KPIs from what, HipCamp, Airbnb, VRBO, Booking.com, all of these are going to be driven into these decisions as well, saying, okay, well, I'm making a lot less money on these OTAs versus doing them in-house. And so maybe you need to ramp up, making them cost more whenever they're on an OTA, or maybe you need them to cost less. So this is a really good way to gauge that as well. But you shouldn't be surprised by your financials at the end of the month, which is, what every part of your story is going to tell you every day. But at the end of the day, it's not just about how full your park is, right? What our occupancy is, but it's about how much we're earning on every single site. So these are just some ways within Stylist that you can start diving in deeper to your specific property and saying, hey, where do I start? And then making our numbers better to be able to have a better daily summary, to have a better trial balance, to be, all around smarter financially. So that's what I have to show in Stylist. Clyde, do you have anything to add to this as well?
A couple questions I was going to answer real quick. I know we're almost at time,
Yep.
but Cynthia asked about setting up tax codes with um, longer than 30 days become tax exempt. You can set that up in your tax settings. So we allow a lot of custom kind of tiered tax settings where it can move to tax exempt. So that's super common. And then Sean asked about revenue pulled into Stateless. It still skews the reports speaking about OTAs through the channel manager. I do want to double check on this, Sean, but I believe your revenue still posts the actual rate and then the transaction amount. So deposit into your account will post the net of the fees. So whatever was collected through the OTA. So the ADR reporting still should be accurate and net ADR should still be accurate. It's just when you're looking at it says this is how much revenue, but you got to take into account the net OTA fees. You might have to go into the OTA to figure out exactly how those fees break down. But other than that, I guess Courtney, we could follow up more on that just to follow up with Sean. But thanks, Courtney. I thought you did a great job. I feel like that there's a lot more to cover, but we did a quick spin through, a
In a
quick pass through
nutshell.
today, a little sneak preview. But we're always happy to help and dive into more as need be, as our customers reach out. So thanks, everyone. Anything else from you, Courtney or Tyler?
Good.
Well, I want to say, Tyler, thank you so much for being Stayla's special guest over this last month, really month and a half. I know that there's so many people who have shot us emails, who've shot you emails, wanting to learn more about moving from cash to accrual, looking through their software system and saying, hey, what am I not doing correctly? Reaching out and talking to, like Nick, an account exec, and they're getting introduced to Staylist because they're seeing these webinars, which is helpful for them and helpful for us as a team too, right? So thank you so much for your expertise. We look forward to seeing you at the next show, and always a pleasure working with you.
My pleasure as well. Thanks,
Thanks
guys.
so much, Tyler.
Thanks,
All right.
everybody.
Thanks, everybody. See ya.
Thanks everyone for joining. I'll see you.